Hello and welcome. I'm an analyst from Talk Tickers, and today we're digging into the H1 2025 earnings from Inditex, the fashion powerhouse behind Zara. And these results gave us a really fascinating puzzle. The company missed on sales, but the stock actually soared. So let's figure out what's going on.
Right, let's get straight into it. The big headline was that Inditex missed its Q2 sales estimates. Now, normally, that's a clear signal for a stock to get hammered, but that is not what happened here. So the real question is, why? What did the market see that wasn't obvious in that top-line number?
And we're not talking about a little bump either. The stock surged 6% during the day after the release. That's a huge vote of confidence from the market. And it tells you investors were looking way, way beyond that single sales figure.
Okay, so to really understand that reaction, we've got to break down the numbers themselves. Let's take a closer look at the key financials for the first half of the year. So here's where you can really see that disconnect. Q2 sales, they missed, coming in at about 10.1 billion euros when the street was looking for 10.3 billion. But look at the gross margin. It held rock solid at 58.3%. In an environment this tough, protecting your profitability like that is a massive sign of just incredible operational control. And this chart right here, it tells a huge part of the story. The reported revenue growth looks pretty sleepy, right? Just 1.6%. But here's the kicker. If you strip out all the negative effects from foreign currency swings, the underlying business actually grew at a much healthier 5.1%. So that currency drag was basically hiding how well the company was really performing. Okay, so if the reported numbers were just kind of meh, why was the market so bullish? Well, this is where we get into the Inditex playbook, the strategy and execution that's giving investors all this confidence. You don't have to take my word for it. The CEO, Oscar Garcia-Mathala, he laid it out himself. He said the story isn't just about sales. It's about solid execution, great gross margin, and disciplined cost control. This is management basically telling the market, hey, we're focused on what we can control, no matter what the broader economy is doing. So how exactly are they pulling this off? Well, it really boils down to three key things. First, their sourcing is super agile and close to home, which lets them react to new trends and tariff issues way faster than their competition. Second, they are just relentlessly pushing new tech into their stores to make everything more efficient. And third, just like the CEO said, disciplined cost control is at the heart of everything they do. And boom, here it is. This is the number that completely changed the conversation. They gave a quick update on how Q3 started, and from August 1st to September 8th, sales growth in constant currency shot up to 9%. So the market basically looked right past that currency hit Q2 and focused on this, a super strong start to the all-important fall and winter season. All right, so with that positive momentum as the backdrop, let's look at what's coming up next, what management is forecasting, and the key things investors are going to be watching. Management is guiding for a stable gross margin for the year, which is great, and they're plowing 1.8 billion euros into capital expenditures to keep growing. But they're also being really upfront about the challenges. They now expect a negative 4% hit from currency for the whole year, and they're actively working to manage any potential tariff impacts from the US. It's a really balanced, no-nonsense outlook. So, looking ahead, here's what's on everyone's radar. That fall/winter sales momentum, that's number one. People will be watching that like a hawk. Then there's progress on their big logistics expansion and the continued rollout of in-store tech. And, of course, any good news on the currency or tariff front would be a huge bonus. So, when you put all these pieces together, what's our final take? It's time for the next call, where we lay out our thesis and our official rating. We are initiating coverage with an outperform rating. In our view, the market's positive reaction was absolutely the right one. So here's our thinking. We believe that Q3 trading update is the real signal here. It points to a strong re-acceleration that's going to define the rest of the year. The company is just a masterclass in operations, managing sourcing, inventory, and costs to fight off those macro pressures. We're predicting the next earnings report will prove this out, leading to a beat on expectations and pushing the stock higher. Now, the market has started to see this, but we think there's still more upside as this execution story continues to unfold. And as always, this is not financial advice.